Kiba, it's good to see you. How are you
You
doing?
too, Matei. Great. How are you?
I'm doing well. Yeah, thanks for joining me. I'm looking forward to our conversation.
Same, always. Great.
So why don't we jump into things? Tell the world, who is Akiba? What's your story?
Yeah, so I guess we'll start a little bit more personal. I was born in Venezuela, lived there for the first 15 years of my life, then moved to Spain, where my family is originally from, and then moved to lived in Sweden for 1 year as an exchange student. Then moved to Israel, met my wife, and then eventually ended up in New York, which is where I started my career in finance. So I started at a consulting firm called Chili's Forensics, where we partnered and worked with some of like the best hedge funds in the world, finding uh, short ideas and helping them figure out what is the accounting angle to some of the most notorious frauds in the last few years. And so one of the first companies that I worked on actually, which is one of the biggest frauds of the past like 15 years or so, was Valiant. And I remember at the time I was just starting because that was a fraud that started, it was like in the 2013 to 2014, 2015 time period. And it was like super interesting to see how applying like this forensic accounting methodology can really help uncover frauds that are missed by most of Wall Street, right? Where the market is basically they're caught on a narrative. And really, by reading really carefully the annual reports and just like all corporate filings, and really trying to understand a company not only from an accounting perspective but from a business perspective and behavioral perspective can get you into what is actually driving the story of a company. And just to like take a step back, essentially what forensic accounting does is uh, you're basically it's a combination of what I just said, I guess. Like accounting on one hand, understanding how the money flows, right? How everything flows from like the different accounting statements, right? So how everything flows from the balance sheet to the income statement to the cash flow statement, and that really gives you like the basis of how to understand a company, right? There's a saying that accounting is is the language of business, right? And it really is. And so really understanding that accounting is kind of like the first step in the forensic accounting research, right? And then the second step is a little bit of having like an open mind of like seeing different trends for a company, right? And really asking like a couple of like simple questions, like changed whenever you see like some change in a trend or in text, what changed, why, and why now, essentially. So the more you can kind of like drill deep into those questions, the better you will be able to understand a company. And so I spent 8 years at Chile Forensics. Valiant was one of the first fraud that I was exposed, and you know,
Can you
then
can you tell us a little bit more about the Valiant fraud? Do you remember some of the
yeah,
details?
yeah. I mean, Valiant was essentially a pharmaceutical roll-up. So they started as a small company. Michael Pearson was the CEO. He was like an ex-McKinsey guy. And McKinsey, he was working for the pharmaceutical industry as a McKinsey consultant, right? And so one of the things that he noticed was like, and this is not a surprise, was that pharmaceutical companies spend a ton of cash in R&D, unsurprisingly, right? And at a moment where it's very hard to be a pharmaceutical investor, right? Like you're investing a ton of money in drugs and R&D that you don't know if they're gonna be viable or not, if they're gonna be FDA approved or not. So he realized like, wow, why instead of like spending all of this money on R&D and hope that you're gonna come up with a drug that will like save multiple lives and make a ton of money for investors, why don't a company just simply buy drugs that work? So that's kind of like the stories. Like, so instead of like spending money on R&D, you spend money on acquisitions, right? And that was the investor story. And that's exactly what they did. They started buying bigger and bigger pharmaceutical companies. And where it becomes a little bit tricky is where is the way that you explain that investment strategy to investors, right? And so if you explain the investment strategy to investors as, we're a roll-up pharmaceutical company. What we do is take investors' money. We find the most profitable, best companies out there. We buy them, and then that's our strategy, right? The problem was that what they were presenting to investors was as if they were generating all of this cash flow from these acquisitions as if they were part of their company. And let me like double click there. So basically what that means is like they were showing all of the benefits of acquiring companies and excluding all of the costs, right? So they will be like, wow, look at like one of the key metrics that they were talking about was free cash flow, for example. And they would say like, wow, look, our free cash flow is amazing, right? So free cash flow, for those who don't know, is cash flow from operations minus capital expenditures, right? Now that excludes the main cost of their strategy, which is acquisition, cash spent on acquisitions. So they were saying, "Wow, look how much free cash flow we're generating," but if you were to include that cash flow from acquisitions, it would be like massively negative. And they were showing obviously like a nice, like really nice trend. So that was kind of like the basis of like the kind of like the basis of the fraud, if you will. And it was one of those companies that especially Wall Street loved that narrative. Like they're doing great acquisitions. Look at the non-GAAP metrics that they're putting out, that of course everyone takes for granted essentially. And they're showing like nice growth. They're acquiring all of these amazing companies, and everything was looking great. But again, if you kind of like understand a little bit of like what the strategy is, B, how the cash is moving and what's actually being generated on one hand and what's actually being spent, right? And number three, it's a matter, and then kind of like understanding how the company is talking about this as well, right? Where they're talking about getting, buying all of these companies and doing all of these acquisitions, but then ignoring all of the costs. So that's kind of like one of the examples where kind of like having like that context of like how everything flows, understanding a narrative that is part of a company, but really digging into the numbers and understanding what actually is happening. It's kind of like part of like the key here, no? And so essentially how that unraveled was that for a roll-up strategy, in order to succeed, you need to buy bigger and bigger companies. That almost by definition, it's bound to end. And so the way it unraveled is that they tried to buy a company called Allergan that used to be the makers of Botox. Allergan did not want to get acquired, and that was a company that it was worth, if I remember, like 30 or 40 billion dollars, like a massive, massive company. I mean, by the time Valiant was already worth also like around 30, 40 billion, if I remember correctly, market cap. So it was like a pretty big company. That acquisition didn't happen, right? And so what happens was that was the acquisition that was key, because you need to, they part of their game is like they need to keep showing growth every year, right? And if all of a sudden you don't have that acquisition happening, that growth at some point, it's gonna look either I don't know, maybe you're like flat if you're lucky, or maybe even down. And that was kind of like gonna like expose the game, if you will. And then there were like a million other things as well happening at the company. Like one of the main strategies that they had, it was not only like they would buy the companies, but then jack up the prices like crazy. Like you would hear at the time some of these stories where, this life-saving drug that, it was not a few people needed it because it was a lifesaver for them. And maybe it cost, let's say, a few $100s a month, right? But it was like a pretty small percentage of the population that needed it. But again, it was a must for them. That a few $100s a month, they jacked up the prices like 1,000%, and all of a sudden it was like tens of thousands or something like that. Yeah. And so that was also back then was kind of like creating a lot of controversy. People were not liking it on top of that. But of course, for Wall Street was like, great. This is like a life-saving drug that people need, and then, and that people need to buy. And probably a lot of times the government was also probably either funding it, so like through Medicaid or helping in cover the costs. So kind of like that story was like resonating a lot. So there was a lot of controversy. Eventually, what killed it was that they were exposed for essentially committing like a pharmaceutical fraud, where they created like fake entities in order to build in order to build like insurance. And in the end, it didn't look like it was Valiant who was getting the money, but they actually are. So, and actually, John Hampton from Bronte Capital, he was one of the ones who was like spearheading that, story and like pointing out a lot of these problems, and was one of the most uh, vocal investors out there, pointing out some of these issues. And he was one of the ones who like found like the Philidor. That was the name of the company that eventually, was found to be connected with Valiant. So yeah, that was a fun one because then you see like the stock price, like like the classic, you go like this, make all the acquisitions, it's great, and then poof.
How it's obviously these stories are always interesting to see how long some of these frauds can last before it gets uncovered. And I'm curious how the technology has changed from when you were doing this kind of forensic accounting, whatever it was, 10 plus years ago, to now, where we have access to better tools, better technology. How can investors spot the next fraud quicker?
Yeah, no, I mean that's a great question. I mean, when I was working at Chile Forensics, we will be using some of the tools that you already are probably very familiar with. Like we were using like AlphaSense and Sentio, which for those who don't know, it's essentially like Google, but for FCC filings. We were using CapIQ, and there was interesting because they had like the CapIQ, like the Excel plugin. So there we actually built a couple of screens that doesn't help clients track companies, particularly more on accounting ratios, but not much more than that. I mean, it was like essentially, yeah, you see, the fact that the filings are digitized. Obviously, that's much easier. Like when this field started with CFRA, and they were doing, I think, all of these research like manually 20, 30 years ago. So having the ability to like really search across filings, it really helped. But to be honest, the technology has I would say, like, to do this kind of forensic accounting research, it has not changed like that much. And I think there's like a lot of room for improvement, particularly now with LLMs, right? So one of they're like, I guess, the the classic way to look for, let's say, short ideas from an accounting perspective was to create like screens based on accounting ratios, right? So you have like the classic would be DSO, like day sales outstanding, or inventory and margins. And that's relatively easy because, it's essentially like putting the information from the balance sheet, the income statement, or the cash flow statement, create a ratio and track it, and that is easily available, right? But that's always part of the story or part of the research for forensic accounting, and that tells you one side. The other side, which is equally important, if not more, is like the text side. So the text side of things, um, being able to identify how there's like a change in accounting policy. So if revenue recognition changes, that's usually pretty significant. And up to the machine learning on text, particularly with LLMs, that was really hard to do. The SEC in the last like 10, 12 years have moved more towards XBRL as part of like the requirements for companies who file their filings with the SEC. So that's helpful because that gives you like some programmatic access to the information. And one of the things that I've been exploring over the past few months is using XBRL data on one hand with LLMs to really understand the text, understand what the accounting policies are, and detect the changes in accounting policies, right? And so that really helps identify that when I was an analyst there, it was not possible. When I was at Chile Forensics in the last year or so, which is when I started getting more interested on the technology side of things, with the help of a developer, we did create like a way to scrape the SEC website based on keywords, and we had created like a little tool to extract some of the information. But it's nothing to do with what LLMs can do right now. LLMs now, even if you put it in ChatGPT, you paste like a couple of accounting policies and say, help me understand what the difference are, or if it's anything concerning here, they can give you like a decent answer. The key obviously is like if you have that expertise, you're able to like create like a great prompt or give examples of what's a concerning change or what's not. But I feel that yeah, there's I feel there's an opportunity there.
And what exactly is that opportunity? Is it to be able to analyze this faster? Is it a scale opportunity where we can do this across a lot more filings? Where exactly is the opportunity?
The opportunity is, yeah, I think those couple of things are definitely part of this. Like on one hand, you're able to um, find the changes in text much more quickly. And so part of like the one of the tools that I've been developing is this forensic accounting tool, right? So we're essentially taking the data from XBRL, which is it's free and it's accessible like through the SEC's website. Although there are a couple APIs like SEC API and there is and CyberSyn that give you access to it. But essentially, you're able to um, create a framework where you can say, okay, tell me all the companies where revenue recognition has changed and is significant and rank them, for example. That's something that before was not possible. I mean, if you were only using AlphaSense or God forbid, like looking at the SEC filings, you have to go one by one, read everything compared to the prior 10K. Like it's not possible. So having that much faster to do it because again now it's like an API call and an LLM, and B, you're able to like do it across all the companies that you're interested in, right? And so the result is um, it's a tool that you can have like the information essentially comes to you, right? If a company just files a 10K, you're able to process it and find the changes without having to, without having to do like a diff analysis and read through the whole document and stuff. No? It's being a bit much more precise, faster, and to be honest, part of it is also it's more accurate and more complete in my opinion, because as an analyst, you might miss things or you're reading through like a whole 10K and you might catch one thing, but maybe you might miss another. Whereas if you have like a way to like say like, hey, this is important, this is like I should take attention of this, and there are only like 10 different issues, it's much more likely that you'll be like, actually, that's actually pretty interesting. Whereas, yeah, if you're just reading through a filing, you might miss it in some cases.
We had Ben Silverman from Verity on the podcast the other week, and he was talking about how they're using insider trading data to detect all sorts of anomalies that might be relevant to the stock. How do you think about using other data sets in order to detect some of these potential frauds?
Yeah, I think the insider trading is interesting because more recently I've been playing with this software called Boardroom Alpha. It's actually pretty interesting because a they have a tool that essentially lets you see a lot of the insider trading. They let you see the information of the CEO and the CFO, the director. They have a score as well, and that was one of the things where it can add a lot of value to research because it can give you like context around, especially if you see like if you have some concerns on the accounting side or on the business side, and you put it into context into okay, is the CEO selling? Is the CEO, are they like buying into this? And if there's like a weakness in the stock, for example, right? And so that's one where seeing some of these tools come out is actually pretty interesting because when I was doing research at Chile Forensic, we didn't have that. So the way we would do that, it was not through Form 4s, although we did that a little bit, but not at that scale, because that's one way where technology can really, really help, right? Because you can aggregate that information across like hundreds of Form 4s that are filed, I think, for every company. But what we would use, it was essentially kind of like a little bit of like a shortcut, which was we would like compare proxy filings where there's a section where they list the majority shareholders and what the executives own, right? And then you can see if any of their percentage ownership changed or not, right? So that can give you a little bit of like an idea, but again, it's not as timely as the first. But it's clear it's one side of the research stack that I'm happy to see, like some tools being developed and being more easily accessible, because I think it's yeah, very interesting, and definitely part of like this forensic accounting, let's say, angle or area of research that that is super important, because like how executives get compensated and whether they're buying or selling. I mean, that's kind of like a direct how do you say, like a direct performance indicator, if you will, of whether you know of how confident the management is on the company.
Yeah. I think it's a great example of how we have all these companies now that are going really deep into some segment of the market or some way of analyzing companies, and then being able to bridge that all together to have a comprehensive view. I mean, now more than ever, we have so much data, and being able to have experts who understand the implications of that, like how the methodologies behind it, like you said, to even just know what are the three forensic accounting questions that you ask and why they matter, and then being able to code that up into some software or some AI models to help do that faster and at scale, I think is going to continue to revolutionize the way that research is done. And I'm curious, you've been posting about some examples of accounting games that are being played. And I was surprised to see companies like Amazon showing up on that list. So it's not just your, although to be fair, even Valiant and some of these companies, right, they're pretty big at the time, and no one expected them to do anything wrong. So tell us, why is Amazon going to be the next fraud?
Yeah, I mean, so yeah, I've been posting a little bit of some of like tidbits, accounting research that I've been companies that I'm interested in, or that I see something from, they find a new 10K, and that's like one example of how I'm using this tool, where it's like it's super, the way that I came up with like that one was Amazon found a 10K. I was curious like if there anything coming up on Amazon that would be interesting to post, right? And I ran the tool, and one of the first things that jumped out to me was how they were changing the useful life of some of their equipment, particularly servers. And this was not so, they just filed a 10K like a month ago. This analysis that I did it like maybe like a month ago, like 2 months ago. So essentially I was comparing the 2023 to the 2022 10Ks, right? So not the latest one. That was like the first post that I put on LinkedIn. And I thought it was interesting because, number one, particularly for AWS, servers is one of like the main costs, right? And anyway, and what happened is like they extended the useful lives from 5 years to 6 years. And at a time where you hear more and more about technological advances, and and ChatGPT and AI was all the rage, and it felt to me that, if anything, just kind of like thinking about it from like a business perspective, it should go all the way, the other way around, right? Like servers should probably be getting shorter useful lives, not longer, no? So that's kind of like something that caught my eye on one hand. The second thing that caught my eye was the fact that um, this was not services like one of the main costs of Amazon and of AWS, but how that was going to show up in the income statement was as like $1 billion in operating profit per quarter. So kind of like a pretty big, it's not small. I mean, and to be fair, Amazon was still gonna report like billions of dollars in profit. So it's not, when it's most concerning is when, they were going to report, let's say, negative profitability. And this all of a sudden, because of the change, they report positive profitability, right? Or, or they use a change in accounting policy to like beat consensus estimates. It sounded like they did talk about it, at least in that quarter, but it's still like a pretty sizable profit, right? And what also was interesting is like, so that's kind of like the second thing that caught my eye. And the third thing was that when you look at the way they were talking about the change, they mentioned it in the earnings call, but they didn't mention it in the earnings release, for example. So it's like, sure, you disclose it and it's in the 10K, and sure, you mention it in the earnings call, but it's not like front and center, let's just say, for something that gave them like a pretty sizable boost. Now, a few weeks ago, when new 10K came out, the latest one, I ran it again. And interestingly, they switched back from 6 years to 5 years. So now there was kind of like an opposite effect, right? So now actually profit was getting lower because of the change, right? Because now essentially what it does is like you have the cost that they capitalized, and now it's getting depreciated over a shorter period of time, meaning that costs go up on an annual basis. But at the same time, they changed. I know now I don't remember exactly which one. I think like some machinery, but they also extended some other machinery. So the net effect was essentially, more or less. I think it was like negative. They still like lowered the profit by a couple 100 million, but it wasn't like, it wasn't the full amount as in the prior year. But as I was writing the post, it struck to me like, it's interesting to also kind of like try to get into the psychology of management as to why are they like so focused on, on changing these useful lives, like what kind of like the point, like, well, we add 1 year here, add 1 year there, and we subtract 1 year from machinery. So it's kind of like, I don't know, it's not like a bear case for Amazon in any sense. They're still making like a ton of cash, a ton of money, but still kind of like makes you think of like, okay, why is management so like focused on these changes as opposed to like focused on the business, if you will,
And I like your point about if you think about it from a macro perspective, that to extend the life of a server in this day and age sounds kind of crazy. And let's assume it would be true. Let's say like they really do believe that these servers are going to last longer and it's warranted to increase the year. Then that has a whole number of second order effects, including like AWS is a huge customer of NVIDIA's. Does that mean that NVIDIA is going to sell less things into AWS? And if that's the case, everyone should just go short NVIDIA today. You heard it on the System2 podcast, which is also a good time to remind people that this is not investment advice. But it's whether it's, yeah, like these accounting changes, if they are representing stuff in the real world, it could have effects. So like, is it just a play some accounting games, or is it a reflection of what reality is in terms of what's happening with technology, or what Amazon believes is going to happen with technology? At the very least, it raises questions that people can then bring up to management and see what the answers are.
Yeah, that's exactly right. It's a great point. And I think one of the reasons they cited for lowering the servers back to 5 years was exactly that. They were like because of AI technological improvements. So yeah, I don't know. It's interesting to note like some of those changes. And I agree with you. For a company like Amazon might not be as you know they're still very profitable, very successful. For other companies, it's a bit more might be more interesting, particularly if they're not as profitable. But yeah, they do have implications for real, of what other companies would follow the same approach as Amazon. They actually believe that servers can last longer, which again intuitively doesn't feel like it, but yeah, can affect like downstream or upstream other companies that are suppliers or vendors. Totally.
Yeah, that just got me wondering whether you can apply this more broadly as an indicator of customers, right? Companies that sell those kinds of assets, if their customers are changing the depreciation life of those assets, that could indicate when they think they're going to have to buy those assets again, and that could play a big role in the sales of those manufacturers of those assets.
Yeah,
What are some other
yeah,
examples?
totally.
You did some other forensic accounting work on a drug company and something else.
Yeah, that was interesting one. So yeah, I was reading, um, going back to Bronte Capital that we touched earlier about the Valiant. They had like their December 2024 letter, and one of the companies that they flagged was Summit Therapeutics, which is a company that has like a market cap of 14 billion. So let me give you like like a step back. So brought the capital. They're long short, but much more focused on the short side. And their investors are pretty good because they provide like pretty interesting detail on a few of the names that they follow or that they're covering. And so this Summit Therapeutics apparently, was flagging on their screen because of, I think because more from like from a management perspective, right? Because what they do is like they follow people and how I guess they had like some kind of like a shady flag on Summit Therapeutic. But they were saying, I think they said that they put a short position there, but they ended up like closing it out. But essentially, it's a $14 billion company, market cap, and that they're in the business of they're developing a cancer drug, and so they're not the ones who are actually doing the R&D. They have a licensing agreement with a company in China called Akeso, right? And basically, what happened was the CEO, Bob Dugan, which is like a billionaire, American billionaire. What he did is like he put $500 million of his own money into the company in order to buy the rights to license the drug in the US, right? It's like a cancer drug, okay? And it's pretty interesting because for a couple of reasons. Like on one hand, the company, as you can imagine, has like no revenues, right? If you look at their financial statement, it's essentially there is this $500 million or so promissory note to Bob Dugan that he gave him in cash. That cash went to pay Akeso for this licensing deal. And Akeso, which is like this Chinese company, they got that cash and it's still TBD whether that drug is going to be approved, right? So the reason why the stock has shot up is because they had like the recent, I think, like stage 3 trials. They were positive, and people are like, wow, this is going to be like the next cure for lung cancer. But where it gets pretty interesting is kind of like the asymmetric position here, where Akeso on one hand has like it's a win-win for them because on one hand they already got like $500 million in cash to license this drug, and they gave like the licensing gave Summit the ability to like sell in the US, in Europe, in Latin America, and in a bunch of places, but they still get like some royalties as well. So it's not like they get zero. Oh, I guess on one hand, it's okay. They benefit if the FDA gets approved, if the FDA approves the drug, but they already got the cash, right? The founder of Akeso has, I think, 5% shares in Summit. Kind of like win if it gets approved because they still have like upside. But if it doesn't get approved, they already kind of like got the cash, they win either way. Whereas for a Summit shareholder, it's a little bit more complicated, right? Like on one hand, um, you're still completely dependent on the FDA, right? If it actually gets approved, great, but it's already a $14 billion market cap. So it's like it almost feels like I don't know what the probability is, but it kind of like has like a good. It sounds like the price assumes that it's gonna get approved to some extent, or it gives like a decent probability, right? I would imagine. But also, because Summit Therapeutics is so. This is something that I forgot to mention, but the float is like 15% of the shares are traded. 85% are still held by insiders. So you have to kind of like question like whether the price movement that you're seeing is because perhaps there's like so little supply available, right? And that there's so little volume like changing hands that that the market cap is the way it is, right? And so just kind of like noting a little bit of like, okay, this is a company that this is the how much it's worth right now. These are like let's call it like the incentive structures between the the company who is actually developing the drug, this Chinese company. And then if you see at Akeso, like during the same time period, because if you imagine, since they also have upside, they should also have seen like a significant bump in their price compared to Summit. Because again, if the FDA if it gets approved by the FDA, both Akeso and Summit should benefit. But Akeso, let's just say the excitement for shareholders of Akeso was less so than for Summit. So yeah, that was one where it was kind of like it sounds like an interesting story to follow.
Speaking of stories, you and I have talked about this in the past. A lot of the context in these situations is important. And the question becomes if you're going to do this at scale using AI, are you able to also piece together this context or these relationships between entities, the different stakeholders? And if not now, what do you think it would take for us to be able to get the full picture on these names?
Yeah, that's a great question. Something that I've been thinking about a lot and speaking to some people about that because at this point, at least in my experience, yeah, you're able to like find this interesting change that like that we discussed. The context, I'm still the one kind of like doing the research into these relationships or into what looking at different filings, right? Now we're kind of like the way AI, depending on how you do it, is looking at one picture, like one part of the picture, but how we'll be able to like get like a more like of a complete picture, right? It's essentially what you're asking, and yeah, that's kind of like the hard part because like a lot of these skills, a lot of these like AI models, they really need like that specialized skills to actually build them, right? And one way to kind of like do that, this is I think it's still like in research mode, it's kind of part of the research that I'm doing is like, okay, can you like train some of these models and say on what hand, like, okay, the training the models so that they'll be able to spot what is interesting, what is not, right? That's number one. Number two is like, can you create like a system that has access to all the filings and other sources of information to be able to get more context, right? And perhaps won't give you like the full picture, but at the end it will be able to like give you other pieces of information. So like for example, and this is something that if you follow the AI landscape, that is already happening with like deep research or with OpenAI, like deep research. That's basically what they're trying to do. Or like, if you see like the DeepSeek that they're like thinking and you kind of like see like their train of thought. That's more or less what that would take, right? You're basically building like a model that is like connecting to. You might be able to connect it to them, on the one hand, for the accounting, but maybe directly with the financial statements. You'll be able to connect them to news. You'll be able to connect it to tweets, and you essentially, as they find like these different signs of concern in this case, can they like go on different tangents and look for information that either support or like help get more clarity, right? I still think it's gonna be really hard for them to do, at least for now, in like 5 years or so, where it's gonna be because this space I feel is like moving like so fast. Um, and then maybe eventually they'll be able to like get relatively close, but like the part of like piecing together like the context, I feel like that's still like hard. I feel like that's pretty hard because part of it is kind of like having the experience of like similar examples in the past or knowing where to look. I think part of it you can help design a system, but I feel that it's like you know it'll take a lot of effort.
Do you think some of the forensic accounting firms, like the one where you used to work, have an advantage in terms of all their research and their internal documentation, all the learnings that they've had that they can use to train one of these models to be able to solve some of this problem? Or do you think startups are able to now compete with these much larger firms because there isn't really much of an advantage in the kind of information? Maybe they don't even have that information stored in such a way that they can use it to train a model.
Yeah, I mean, I would say it's hard to do this like well without having expert knowledge, and this you could tell about that in many areas, particularly in finance. I feel like. So there's just like so much that you can, if an AI model, you can train it on all the financial data and give all of the financial statements. But if you don't, then give like access to corporate filings and 10Ks and 10Qs. But I feel that there is like a training and having like this domain expertise to be able to tell the AI, this is concerning, this is not, this is red, this is yellow, this is green. So I do feel that just being like a startup, and there are a couple of those, to be honest. Like there's some guys like what's called like Transparently, I think it's called, like ex Google guys, that are basically using like machine learning, and they have like they have like a score, and they're like, okay, this is like the business impact, and these are like different accounting issues, and sure, you can like train it to some extent, and I'll give you like something that is interesting, but there's always gonna be something, if you know if you know what you're doing, there's always gonna be something like, it's not giving me everything that I need. So that's kind of like number one. I feel like there is like the domain expertise is like super important in these cases. Number two, having that library of knowledge, I think is hugely important, particularly because of the information that the AI needs to actually be able to understand what's interesting or not. The games that the company used to play, the accounting games that a company used to play 10, 15 years ago also evolved. The classic book here is Financial Shenanigans. Is the classic book on forensic accounting, right? And every few years they update it, and there's always like new games that they find. These M&A games of like roll-ups, they were not prominent, let's say, maybe like 20 years ago when the book came out, and 20 or 30 years ago when the book came out, as now. So there's always like new games that companies can play, right? There are changes in regulation. There are changes in accounting that happens every year as well, that can create opportunities on certain industries. The way an accounting gets applied to a specific sector or industry is also important, and that change. So it's not like accounting is not static either. So the way revenue is recognized in the last 6-7 years is different than when it was recognized before then, because that was like a big change in accounting. So there are a lot of like these things where having that library of knowledge and it's really important. But the key, as you said, is like, okay, how do you translate those, let's say PDFs or Excel spreadsheets in a way that a system like an AI system can understand it and can really like say, okay, these are defined, this is what you found, and this is like the pattern of thought that you need to go through to actually find it. So I think there's some areas of improvement, and you can get maybe like 50 or 60% there, but I feel that it's hard at this point to just get it without any kind of like guidance. That guidance is also like it's hard because it takes time, and you need the expert to also like do that guidance to the AI. Yeah.
I like that to apply some of your forensic accounting framework where you're starting off by asking what has changed, but to do that at a more macro level to identify regimes when these types of fraud are maybe more likely. And it could be, like you said, because some regulation changed or there's some other changes that are happening. I'm wondering if you can expand a little bit more on that. Are there also certain, like say that there's a downturn in a sector where these types of frauds are more likely to come out, to your point, because they can hide a lot of it in a growth cycle, but when things turn, they won't be able to hide it as much. How should we think about it from, if we're thinking about this in different regimes, these frauds might be happening all the time, or maybe they're more clustered in certain time periods or as a reaction to certain events. And I'm curious if you have any opinion as to what regime we might be in right now or entering.
Yeah. I mean, a couple of things that came up. Like on one hand, there's always like certain like sectors that are more prone to this kind of accounting games, right? The classic ones are like grocery stores, right? Because that's a sector that is super stable. Margins are tiny. It's really hard to get growth. It's really hard to get profit because you're dealing with groceries. And so some of like the big accounting frauds of the past like 20, 30 years, like Parmalat, Dia, Casino, they come from grocery stores and supermarkets like that, no? And so that's like on one hand. On the other hand, it's also something else that came up to mind is that depending on where we are, to your point, on a macro basis, people care more or less about this, right? So if the market is like in growth mode, let's say, people tend to overlook some of these accounting changes because like the whole market is going up, they buy the dip kind of thing, that. But so if they're like playing with the amortization or they change these accounting policies, like, well, kind of like, who cares, no? So it's certainly like, when the markets are more frothy, I would say it's not like this is less important. This is investors care less, if you will. However, when the market is not doing so well, and perhaps now is one of those times where you have like high interest rates, there's a lot of questions around, particularly in the last few years, of like, okay, growth cannot like sustain valuations anymore. You actually need some kind of profitability, right? And so that's where investors actually start looking at the fundamentals much more closely, right? Is this company actually able to generate a profit, or do they still are going to be burning cash from investors, right? And so that's one where this kind of analysis is more important because it allows you to get closer to the truth in that sense, right? And right now, I feel that we're one of those situations where the market is at a time where I think people are still looking at fundamentals, particularly because there's a lot of volatility on one hand, right? It's not like before when the market is just going up, but there's like opportunity on the long side and opportunity on the short side, and now having that ability to understand the companies more on the fundamental level. I think investors are more looking at that. Those probably part of it is also because they're more. I think because of the advances in AI, and you see a few more startups in the space being able to provide insights into corporate filings. You see like companies, the classic example of the ChatGPT for finance. That's something that I feel that every month you see one, where it's like, you can chat with the 10Ks and the 10Qs, and so, having that. I feel like that might be indicative of investors wanting to be more having more options to like look at at the fundamentals as well.
So if I'm a fundamental research analyst, what kind of yellow flags should I be looking out for in my companies so that I would give you a call to see if there's anything actually wrong there?
I would say like the main, at a high level, what you really want to be looking at, if you want to keep it like as simple as possible, you know, get the balance sheet, get the income statement, get the cash flow statement, try to see where the company, the numbers and the trends make sense. And when I say make sense, it's like if you all of a sudden see, I don't know, accounts receivable spiking up or spiking down, or any like a really big movement in other assets or any other account that you don't understand completely, there might be something going on that you really want to understand as an investor. There might be like an accounting change, there might be like a business change, there might be like some acquisition, there might be something going on that you should, as an investor, you should get smarter, because it can potentially be something important for that investment.
Awesome.
So looking at the changes, that's always what drives this. Looking at the changes and understanding them.
So if I were to commit fraud, you just have to not change anything and just make your fraud be as stable as possible. We're always returning 8% a year, no matter what. Don't ask why.
Basically,
Yeah,
don't ask why. I mean, then you just have like everything very hidden, everything I don't know off balance sheet. No one asking questions.
exactly.
But yeah, more stable is less, draws less scrutiny, I guess, to some extent. You know,
We've seen situations where that goes poorly as well. Well, I
that's
think we
right.
should encourage our listeners to send us some questions on some names that they think might be shady, and then we'll get Aquiba on and it'll tell us what's going on.
Happy to.
Awesome,
Awesome.
awesome, Aquiba. Well, thank you so much for joining us today.
Of course,
It
Matei.
was a
We'll talk
pleasure.
soon.
All right, see you.
Bye.
Bye.
Ciao.